ads are dead, long live the ads. I do think we'll find a way, and they'll find a way to monetize it.
And it will all happen on stablecoin rails.
Yeah. Well, instead of scrolling Instagram, yeah, you'll have conversational ads and you'll pay for them in stablecoins. All right, we're back for another episode of In the Charts. I think for this episode, we're actually all can't tell from our backgrounds, but we're all in person in the office. I'm going to start us off this week. Hold on.
I'm excited. What do you have for us,
Okay.
Breck?
So I've got two charts. This is the first chart. This is also from the Bond Capital AI report, which I discussed in the last episode. This is specific to ChatGPT, metrics around users, subscribers, and revenue. So the first chart on the left shows ChatGPT going from 0 users in 2022 to 800 million monthly active users in less than 3 years. But it also shows that only 20 million of those are actually subscribers. So people that are actually paying OpenAI and ChatGPT. And they're obviously making quite a bit of revenue. They're trending towards being one of the most valuable companies in the world. But I thought the fact that they only monetized less than something like 2.5% of their customer base was really interesting. And I ended up coming across a separate chart that maybe explains why. And I'm going to try and somehow make this around stablecoins. Circle's stock price is pumping. Everyone's talking about stablecoins, and I think there might be a bit of a stablecoin story here. So the second chart shows the growth of users outside of North America, or the percentage of users outside of North America. The blue line is the internet, and the red line is OpenAI and ChatGPT. So over 90% of ChatGPT's users are outside of the US. And they're only currently able to monetize 2.5% of their users. So maybe there's a story here about payments. And I kind of want to tell that story. We know that stablecoins are really, really useful for facilitating cross-border flows. We know stablecoins are really, really useful for the repatriation of US dollars from long-tail foreign currencies. And we've also been trying to answer this question of what is the killer use case for crypto and AI. And I actually think it might be OpenAI's adoption of stablecoins to actually monetize the majority of their user base and making the business more efficient and more effective at actually doing that. I could imagine there being a story of it's ineffective for them to through traditional payment gateways try and have a de minimis subscription or charge per API. But maybe with stablecoins is actually more efficient for them to do so. So I wanted to kind of I saw this, and the first thing I thought was, why is OpenAI not using stablecoins? And I know there's more enterprise adoptions of stablecoins, and I don't know. This hit me in the face, and I wanted to use that as a discussion topic and see what you guys thought about it.
The first thing that comes to mind is, of course, ChatGPT has a lot more adoption outside of the US because one of the primary use cases is translation to English. And so the fact that everybody wants to have fantastic written English, and it was the killer use case, obviously writing and digesting and summarizing and answering emails. And that's like the killer use case here. That would mean that people outside of the US have a lot more need. That was actually my first instinct. You went in a direction that I did not expect.
Well, it's like the meme of what does the Iran and Israel ceasefire mean for B2B SaaS? It's like, how can I make this thing that's not about stablecoins about stablecoins? Because that's seemingly what everyone's doing. And we like to, as crypto investors, use the stablecoin lens for whatever the problem du jour is.
Yeah, I'm also going to ignore the prompt and not talk about stablecoins. But I think it does highlight just how quickly these businesses can become global. It's actually really interesting because, the first generation, obviously, of internet applications were only relevant to people that had the physical infrastructure that provided them the internet. And then the next generation of that it was kind of true as well because you kind of needed fast broadband in order to get the latest and greatest in terms of streaming videos or something like that. And there's always a lag between, people that get it first versus people that get it later. And at this point, the internet penetration is so deep that actually this is one of the first instances I think that we know of where you kind of launched this very global applicable product on day one to a group of users that already have this physical infrastructure built in. So I think this is just going to be the first of, I mean, maybe not the first actually. Maybe there are some others that have come before, but one of the great examples of how quickly an internet business can go global and reach scale as long as it's got the right kind of prerequisites and feature sets and applicability to this global user base.
I totally agree. I was thinking about
Yeah.
that. And the other thought was, how much quicker can we get? At some point, there's an upper bound, which is instant. 8 billion people have it, right? That's the upper bound. But how much quicker can we get? Because it's already really freaking fast to get like the 100 million to billion users and to get to all of the installed base on the internet. So we can't have apps that do much better than this from now on, right? It's not going to be as much of a difference. That's my thought, at least.
To try and bring it back to stablecoins.
Trying so hard.
No, do you think it's reasonable for OpenAI on an ongoing basis to only monetize 2.5% of their customers? Like the incremental cost of someone using their underlying servers, like inference costs, is way higher than the average cost of someone joining Twitter and writing a tweet. Like the like unit economics are not the same. So I was really surprised. Obviously they have probably infinite access to capital in the private markets, but like it can't be possible that they continue just charging this thing or charging zero for this thing for the vast majority of users at this scale. Like it's kind of crazy. 780 million people are using this thing on a monthly basis, not paying for it. And it's not
One
for
of the things
for
right.
OpenAI.
So I still think there's room
today.
Yeah. And so I do think that number one, they will charge more in the future, but the way that they'll charge or when they charge is going to be kind of an interesting question. So think about it this way. I think the switching cost of these things is actually extremely low. So they have to keep themselves on the forefront, always competing with the best models. And that actually what it means is that they shouldn't add enough of a barrier such that they don't become obviously the dominant platform and continue to grow. That seems to be what's happening, which is the real end game is some kind of device, something that actually has physical network effects and that they have a lock-in on the user base. At that point, they can actually go into extraction mode. But until then, they just have to be, you see the models like switching number one every week, every month.
Yeah,
and
totally.
they don't have a massive advantage. And so you're not going to monetize the users and really push for it until you have a moat.
Yeah. I also do you know how they charge for devs building on top?
Yeah,
Was
so
the
it's
other
API and Spur token, and it's just
Yeah.
like a normal.
So that would make sense to me. And you could almost imagine ChatGPT, the consumer product, as kind of what Gmail was for Google. Entirely free service. I mean, you can get premium tiers if you want, but entirely free service. But at the end of the day, helps them to close the loop on search. And so you could imagine something similar and justifying it that way. You could also imagine them applying some freemium type of business model to it. And so,
I think it's
all
funny.
roads
I
lead to
think
ads at some point.
yes, all roads lead to ads, and I think to a large extent it's underappreciated. We've been saying, ChatGPT and just chat in general kills search, and thus like the ads model is dead. But I do think that we're going to find fantastic ways to kind of like have ads, to have way more curated ads, have way more relevant ads, people bidding for stuff, services that are underlying, like where do you book the flights, stuff that are commodities. I do think that there's going to be a way for ads to have a major resurgence. So, ads are dead, long live the ads. I do think we'll find a way, and they'll find a way to monetize it.
And it will all happen on stablecoin rails.
Yeah. Well, instead of scrolling Instagram, yeah, you'll have conversational ads and you'll pay for them in stablecoins. That's right.
Awesome. Well, I'm going to go into my chart, which also has AI into it. The title is Year-on-Year Change in U.S. Tech Employment. And so on the y-axis, we have year-on-year change in terms of thousands of jobs that are coming to market. And on the x-axis, you just have time. So from 2016, roughly all the way to 2025. So a pretty current chart. This is by Joseph Politano using DLS data. I thought this was kind of a fascinating chart because in general, I think the story of the past, couple of decades of tech has been, we need more developers. We are starved for resources. We need more engineers. We don't have enough engineers. That was always the story. The universities are not keeping up with demands. And then you obviously have COVID in 2020 and nobody's hiring. Everybody freezes hiring. I mean, Anchorage included, right? In hindsight, maybe a mistake because immediately the overhang of COVID is a major boom in the markets, boom in hiring. AI hits amazing stride, and then everything starts going. Everybody starts hiring, and then you have this like descent to negative. You realize that in 2024, we're doing worse in terms of year-on-year change of adding jobs that are engineering jobs than we did during COVID. And then that trend recovers a little bit in 2025, but it's now back to negative. And so it's it's kind of interesting to obviously overlay this with AI jobs and what we're always saying. And obviously, causation and correlation are two very different things, but it's just fascinating that the weighted moving average and the average of the past, if we did this chart to 2020, I think we would have seen the same things that we're seeing in 2018 until 2020, and which is massive demand for engineers. And now we're kind of like, we're at zero. And so, really, like, one interpretation is the obvious interpretation, which is senior engineers are becoming much better with these AI tools, and junior engineers are not having a chance. And I think anecdotally, we're seeing lots of evidence of interns and folks entering the job market, even with software engineering degrees from great universities, not being able to actually get through and get these jobs. It's absolutely fascinating. I do think that there's obvious correlation to the AI phenomenon, but there's probably also causation here with the AI phenomenon. And so I couldn't stop myself from bringing this chart because I think it's actually, it's kind of crazy to see this as it is right now.
This is a really interesting chart. I think there's a couple things that stand out to me. The first thing that's really evident is if you just follow the red line, just the change in slope. So, pre 2018, yeah, it's growing. It kind of feels like linear with some bumps here and there. And then there's COVID, and then there's this really steep drop off. And then there's the post COVID where there's this really steep run up, and then now the really steep drop off again, going all the way down to 2024. And the slope of change on this relative to before COVID is just insane. And there's a lot of whiplash here. So that's observation number one. Observation number two is look at the area under the curve from 2020 to call it 2023 or and a half, right? Like June of 2023 is massive. And so even if we had this dip in 2024, the area under the curve there is tinier actually relative to the, growth and the surplus that we accumulated even just during this, call it COVID era. And so while the sentiment feels like we've got a lot of whiplash because the slope of the curve has been going up and down in a very violent way, in terms of sheer magnitude, I mean, we still haven't even recovered a fraction of the job growth that we've seen, from 2020 to 2023. So those are two things that really stood out to me. I was also trying to make out the colors within this,
It
and
just doesn't matter
I
what the colors
mean,
are because everything is down. And so, everything is down to zero. And I think the question
yeah,
following this up is, will this change? Do you feel, looking at this graph, what does this graph like instinctively tell you? Like, that's, how do you run this forward? If you had to predict how the chart goes forward, how do you run this forward? Because I don't see this like really getting off of zero materially.
It's almost like there are two things that kind of run in the back of my mind of this. Like, I have to imagine the largest contributors to this are big tech. It's like basically it's Google hiring or firing, is Microsoft hiring or firing, is Meta hiring or firing. Like that's got to be the vast majority of these jobs. So clearly, COVID, there's a stop. Then there's a boom in ZERP, and then there's like, oh crap, AI is now killing some of these businesses, like literally as we speak. Like we know Google search is down year over year for the first time, like in ever. The second thing that I kind of asked when you asked that question, Diogo, is like, are we in a recalibration stage where actually everyone's just a software publisher now because of the tools of AI? Like, I could be classically trained as a lawyer and like be a GC and hired as someone on the legal team, but now I can write code. And like, is there some grand reclassification that's happening where just like everyone will now have the skills and ability to do this? So you don't get hired as an engineer, but like maybe there's actually more code that will ever be written Like we're just the tip of the iceberg for code that's generated and written, but there's less engineers themselves, and that's kind of an interesting uh reframing of this, because like yes, clearly there's less engineers, but it's because everyone's going to be an engineer.
Yeah. Or another way to think about this is looking at strictly US tech employment. But you could also, I don't know how you'd measure this, but if you think about what is the impact or value created from tech, you could also argue that yes, within the tech sector, some decline in growth and employment, but the net impact of the technology has actually influenced and impacted, the remaining industries plus like 10, 20, 30, maybe even 50% in terms of productivity. So that's the other side of the argument that I think, is not shown on the chart.
It's also so ironic. Like I can remember in 2019 going to an Andrew Yang like thing in San Francisco, and his whole thing was like the truck drivers are going to get disrupted by autonomous driving, and it's like a bunch of like tech workers, myself included, being like, yeah, like UBI, and then now it's like we're the ones being disrupted. Like we didn't see it coming at all, and it's so ironic how like the thing that's hitting you in the face, you just like don't recognize it until afterwards. I don't know.
Awesome, Chris. What'd you bring us?
I'm going to go to a chart that actually talks about stablecoin.
So there's a bot word.
Here we go. So there's a lot of words here. But basically the chart is just a percentage of basically institutional investors that are overweight or underweight the US dollar. And so you could see in 2005 in January, a lot of firms were underweight the dollar. For most of the 2010s, or maybe all of the 2010s, really, people were overweight the US dollar. And then there's just this massive drop off in the last couple of months where a lot of people have become underweight the dollar. So, some of the words are, net 31% of institutional investors are underweight the dollar, which is the greatest percentage in 20 years. And basically, the chart is showing you that the dollar is very unpopular among the institutional investor base. And I wanted to talk about this because obviously with stablecoins, the opposite is kind of true, which is it only works because we have the US dollar in a lot of ways. The capital efficiency gains from stablecoins are due to the fact that the dollar has a lot of liquidity and it's a currency that's accepted in a lot of regions around the world. Sometimes people will hold on to the US dollar for its anti-inflationary properties relative to their own hyper-volatile currencies. And so there's a lot of properties that are very specific to the US dollar, which makes the stablecoin work. And so I guess one of the things that I'm curious about is what is the impact of this? Does this weaken the stablecoin narrative and weaken the value propositions of a stablecoin? Is this going to force us to think about new stable coins that are not US dollar denominated? And is that interesting or is that worth it? Could we think of a new basket of crypto assets or something else that is going to replace the dollar in some form? But I think this is important to talk about because clearly over the last, 15 years, it hasn't really been relevant, but there's clearly a change that's happening now.
Yeah, it's kind of fascinating. I mean, a lot of the things that drive this is that people don't want to buy American assets, right? They don't want to buy American assets. They have less of a need for dollars because you have to buy American assets using dollars. So there's like many pockets of demand. I do think that simultaneously we can have the pocket of demand of holding the dollar as a store of value increase massively in places where historically people have been underbanked and they have hyperinflation, et cetera, while the investor class, which controls a lot of money, is uninterested in investing into the United States as much as they would, and they sort of sell their investments and move them elsewhere. So I think those two things may actually be happening simultaneously. So to a certain extent, stablecoins are actually helping tremendously add demand. It's just the lack of demand for the investable asset class is actually even larger. And so you're not seeing a net neutral, like the outflows are even higher than the net new inflows. I don't know if I would say that even rolling this forward. I think the threshold, there's no alternative to the United States dollar really as the trading pair and currency for all of these things. So I think demand is going to go up, is going to go down, but it's going to be around the edges. And the training range of dollar to euro, for example. I mean, it's been pretty wide, but in general, it's been actually like pretty narrow over time. So I don't know if this kind of like leads to the conclusion there's going to be other stable coins that are going to be local. I think everybody's going to want to have the dollar, especially since all of DeFi is dollar denominated. There are network effects in Tether and Circle and all these stable coins which are dollar denominated, and it becomes extremely hard to kind of replace them. So I don't know. I don't know if I had to bet, I would take the other side of the argument that local stablecoin or local currencies, stable coins backed by local fiat currencies, whatever euro, become popular due to this, and it's much likelier that this just will ebb and flow, and nothing will change, and the future is still dollar denominated.
Yeah, I tend to agree. Like, if the question is they're underweight to the US dollar relative to another currency, I don't know. I find that hard to believe. I'd be really interested to know what the other currencies are that they like are overweight to. Like, so Chris, do you know, like, is this underweight relative to the rest of them?
I mean, Europe has been going up in terms of investments. People are, going to Germany. They believe Germany now is finally investing. That Europe is doing a resurgence. So, and you can see it. The euro has been up pretty significantly towards the dollar. I think from a low of like 105 all the way to 116 now today. And so if you see that, Europe is definitely one of the beneficiaries of a weak dollar. People are moving assets to Europe.
Yeah, liquidity, I think, is just fragmenting away from the US dollar. People are just diversifying a bit more. It doesn't say that the dollar is no longer the dominant currency. It just means that on a relative basis, I think they're losing. And it's probably important to talk about why this might be happening. And this is largely due to the fiscal situation in the US, where people are worried about the rising debt, deficits, the high cost to service that debt, and the interest payments that are going to weigh down the economy in the future. So, that's a large part of it. But to your guys' point, I don't think there's a real creditable alternative, which is the good thing. But at the same time, I think it's important to note that it's weakening on a relative basis. And the more that it weakens, the more it creates an incentive for people to think about, well, I don't want to be 100% beholden to this. So what else can I create that's going to give me the type of diversification and the safety that I need?
Awesome. I think that's a wrap for this week's episode of In the Charts.
Yeah,
We'll
see you in 5
guys
minutes.
next time. See you guys.